A very happy and prosperous 2024 to all of you from Team SBI Funds Management. What a year it was, 2023. I remember this is what we said at the start of 2023. We said, inflation has peaked but will still stay above central bank's target globally. We are at mature stage of rate hiking cycle. Growth would slow down by the end of the year. China is reopening, but structural challenges in the economy could lead growth to underwhelm. Markets are rallying, eyeing what they see, not just a near-term pause, but also a U-turn by the US Fed and consequently by others. India is fundamentally in a good shape, but faces risk from global growth slowdown. Much of it can be repeated today as well. Just because the markets have been here before does not mean they will not be right this time. But let's take a more nuanced approach. Given a remarkably dovish turn by Fed in its December policy, financial markets ended 2023 on an optimistic note. By year end, markets are pricing in 125 to 150 basis point of rate cut from US Fed and European Central Bank over the course of 2024. And on these expectations, 2023 has ended with the risk assets outperforming. We certainly do not expect further rate rises, but we suspect that the reaction is a bit overdone. Growth inflation mix has certainly shifted in the favor of a pause to monetary tightening. US inflation is near 3% and is expected to slowly move towards 2.5%. Eurozone printed 2.4% in its November CPI and faces a deeper risk of falling growth. Ex of US, China and India, growth has slowed markedly in many countries, including virtually all of Western Europe. Bank lending is contracting in the developed world. But there is still much that central banks cannot know, and yet they will need to decide both when to cut and by how much. Cutting too soon would mean they find themselves having to quickly reverse course if the downward trend in inflation does not persist, in which case a resumption of tightening could trigger renewed economic weakness. Clearly, there is also a risk if that they wait too long to ease, it could result in a much harder landing. The current economic landscape is hugely complicated. Unlike the past, inflation has fallen without a big rise in unemployment. Real wage growth in the developed market is positive. Will that keep consumer spending resilient, or will consumer confidence finally crack? As growth slows, will companies finally shed jobs or continue to hoard like they did in 2023? How quickly will accumulated savings run down? The global impact of China's recent policy measures is highly uncertain, adding to the commodity price risks that could arise from geopolitical conflicts. Monetary policy is restrictive, but at what pace will it feed into real economy? Fiscal policy, on the other hand, is not restrictive enough. All in all, slowdown is inevitable, but the real question is, will it be stark enough to spark a risk-off sentiment or Fed to act faster and deeper? As of now, probability is equally balanced towards status quo on rates and rate cuts. We need to see a clearer signs of labor market cracking or a stronger visibility of inflation falling within the target. Unless rate cuts look like a done deal, we could see more of 2023 in terms of asset price moves. That is, any asset class will lack a clear direction and rally. Coming to India, 2023 global macro backdrop was less hostile for India than thought out at the start of the year. global growth is tracking nearly 1 percentage point higher than envisaged at the start of 2023. Decline in India's exports wasn't as sharp as feared. Commodity costs were contained, thereby improving India's terms of trade. Tighter monetary conditions did not spill as much in India, as manifested in narrowing bond spreads vis-a-vis the US and surge in FII inflow. In India, overall tax collection stayed healthy, helping the central government to largely execute its ambitious capex targets. The real surprise came in the strength of growth in the state government capex. A part of it is also associated with front loading of capex, and it will likely moderate in second half FY24. India's real GDP grew by 7.7% in first half FY24, driven more by investment than consumption on the demand side and by a stronger growth in manufacturing over services. Reported GDP prints could plausibly be a bit exaggerated, but statistical nuances aside, a strong bank credit growth, GST collection, electricity generation, cement and steel production is an indication that the supply side of the economy is doing good. Government's infrastructure thrust, coupled with ongoing manufacturing sector and real estate recovery in India, has kept the supply side of the economy robust. Looking ahead, if the general perception of modest slowdown in developed countries hold true, India's real growth could also be a respectable 6 to 6.5% in FY25. We expect government to stay put on its fiscal consolidation agenda, achieve its stated 5.9% of GDP target in FY24 and continue to bat for 4.6% by FY26. In FY24, tax and dividend flows have been supportive to the central government to somewhat increase its pre-elections welfare spending without compromising on its capex goals. But now, we do suspect government capex to moderate from here on. Real estate recovery, on the other hand, has more legs to go. Healthy balance sheets have meant that the financial sector is able to grow again. Even though we are optimistic regarding the private capex, a strong cash flow within the corporates implies a reduced need to borrow and invest. Overall, we expect 11 to 12% of bank credit growth for FY25. Consumption demand hasn't been exciting post-COVID. As gauged from volume growth in FMCG, demand for white goods in recent quarters, and various other retail segments. Auto has just bottomed out in 2023, but still lacks the peaks of 2018-19. But cash flow to low-income households are improving, helped by rising construction, manufacturing, and real estate activities. State and centers' welfare spending has also increased a bit. At the margin, we are incrementally more positive on rural India over urban India. But more importantly, FY25 looks set to be another year of single-digit nominal GDP growth, and hence a likely situation of modest top-line growth for companies. Sharp commodity deflation in FY24 has helped the profit growth despite a meek top line. Can this be repeated in FY25? The odds are less likely. India was one of the few emerging market countries to deliver positive returns in 2023. In fact, equities have given a respectable positive returns in the last 5 years. India's biggest weakness in the past has been its twin deficit issues, which meant that each time oil prices rose, or the Fed tightened, or the US dollar rose, India found itself low on hard currency. Increasingly in recent years, RBI's ample FX reserves, rising services exports, and improving tax buoyancy meant that its vulnerability to these factors are reducing at the margin, as manifested in reduced INR volatility. And hence, Indian equities remain attractive over medium term. Valuation and over-exuberance in sentiments are the pain points for Indian equities at the moment. On rate cut, if global rate cutting cycle starts, we would see RBI changing its tone and give some rate cuts in India too, though it will not come before August. Biggest risk to this call is weather and crude prices, and the biggest driver for this call would be Fed starting to cut. Banking system liquidity finally ended its post-COVID surpluses in Q3 FY24, driving overnight rates to trade above repo. Looking ahead, given the modest outlook on FX inflow and an organic INR 3 to 4 trillion of currency leakage that happens every year, liquidity is likely to remain in neutral to deficit zone unless RBI's stance changes towards the OMO. External account backdrop looks benign in FY25 and current account deficit would likely stay under 2% of GDP. Manufacturing sector recovery is keeping non-oil, non-gold import elevated, though a benign global commodity environment should keep a lid on the oil bills for India. Despite the likely bond index related healthy FPI inflow, overall balance of payment looks broadly neutral to marginal surplus. Global FDI flows is moderating and India is witnessing a higher repatriation of past FDI inflows. Hence, so far, government's production-linked incentives haven't been able to garner material interest from the global companies. On dollar, near-term backdrop of fading US exceptionalism and falling US yields means DXY could soften, but eventually Fed easing may also go hand in hand with worsening global growth, which could spark risk of environment and cause dollar to strengthen a bit. But given that this global growth weakness has been very prolonged and rolling rather than a sudden sharp collapse, the extent of strength may also be capped to an extent. In India, both macro factors and RBI's intervention strategy suggest a continuation of a range-bound rupee in 2024 and a marginal depreciation towards 83 to 85 range. An expectation of supported growth alongside disinflation in FY25 rests on two critical assumptions of contained commodity costs and soft landing. Domestically, political stability implying a policy continuity is also critical underlying assumption for a healthy macro outlook for India in FY25. Prospects of positive real rates, better fiscal outlook, potential index flows, and a mature rate cycle provides confidence to add portfolio duration on upticks with a longer term holding period with regards to fixed income assets. Money market assets continue to provide adequate value and inflation-adjusted carry for short holding period investments. Within asset classes, G-Secs and SDLs provide a higher relative value over high-grade bonds as spreads remain tight, especially at the longer end of the curve. Signing off for this month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.